You've been sitting in that dealership for 2 hours. The salesperson slides a paper across the desk and you see it, a monthly payment that's $300 lower than buying the same car outright. And in that moment, something happens in your brain. It just feels like the obvious choice. But what if I told you that lower payment is one of the most cleverly disguised financial traps in the modern world? Stick around, because by the end of this video, you are going to see car leasing for exactly what it is. Let's start with the number that dealerships love to advertise and hate to explain. That attractive monthly payment. When you lease a car, you are not paying to own it. You are paying for the privilege of using it while it loses value. The dealership essentially charges you for the depreciation that happens during your lease term, plus interest, plus fees. So you hand over thousands of dollars across 2 or 3 years and walk away with absolutely nothing. No asset, no equity, no car, just a receipt and a handshake. Compare that to buying a car, where every single payment builds toward ownership of something tangible. Now here's where the psychology gets really interesting. Dealerships know that human beings are wired to focus on monthly costs rather than total costs. It is called present bias, and it is the same reason people buy things on installment plans without adding up what they actually spend over time. A lease payment feels manageable. But zoom out and calculate the full picture, and the numbers tell a very different story. Over 6 years, which is 2 standard 3-year leases back to back, you could easily spend $40,000 and own nothing. Whereas someone who financed a car for 5 years would be driving a paid-off vehicle by year 6, building equity the whole time. Let us talk about mileage caps, because this is the part that catches people completely off guard. Most leases limit you to somewhere between 10,000 and 15,000 miles per year. Go over that limit, and you are paying a penalty per mile at the end, typically between 10 and 30 cents per extra mile. Sounds small, right? Do the math. If you drive 5,000 miles over your limit, that is potentially $1,500 in overage fees, handed over on top of everything else you already paid. And if you have ever had a long commute, taken road trips, or simply lived life, hitting that cap is far easier than you think. Then there are the wear and tear charges. When you return a leased vehicle, an inspector goes over every inch of that car. And the definition of acceptable wear and tear is frustratingly subjective. A small door ding, a minor scuff on a bumper, slightly worn tires. These can all become line items on a bill that blindsides you at lease end. You will have spent years treating someone else's car like your own, and then you get charged for using it like a normal human being. Let's address the insurance angle too, because most people don't realize that leased vehicles typically require higher coverage levels than what you might choose on a car you own outright. Gap insurance is often mandatory or strongly recommended as well, because if the car gets totaled, the insurance payout might not cover what you still owe on the lease. So add those increased premiums to your running total of what leasing actually costs you. Here's another layer that rarely gets discussed. You have zero flexibility inside a lease. If your financial situation changes, job loss, a growing family, a relocation, you cannot just sell the car and move on. Breaking a lease early comes with penalties that can cost thousands of dollars. You are locked in, and the leasing company has all the leverage. Car ownership gives you freedom. Leasing gives you a contract with very little room to breathe. Some people argue that leasing makes sense if you are a business owner writing off vehicle expenses. And there's some truth there. The tax treatment of leases can be favorable in specific business contexts. But for the average person watching this video, that argument does not apply. And even for business owners, buying and depreciating a vehicle often produces comparable or better outcomes depending on the situation. Others say, leasing lets you always drive a new car with the latest technology and a fresh warranty. That sounds appealing on the surface. But ask yourself honestly, do you actually need a brand new car every 3 years? Or have you been conditioned by advertising and social status pressures to believe you do? A well-maintained used vehicle can serve you just as reliably for a fraction of the cost, and it does not come with mileage caps, return condition anxiety, or the guaranteed certainty of always having a monthly payment. That is actually the deeper issue at the heart of leasing culture. It normalizes the idea of perpetual car payments as a permanent feature of adult life. You finish one lease and roll straight into another. The dealership loves this. The finance company loves this. Your bank account, on the other hand, is taking a serious and ongoing hit. Financial independence is built by reducing recurring obligations, not locking yourself into a new one every 36 months. The smartest car move most people can make is to buy a reliable used vehicle, pay it off, then drive it for years without any payment at all. That gap between what you were spending and what you now spend goes straight toward building wealth, investing, saving for something that actually matters to your future. So next time you are sitting across from that salesperson and they slide that paper with the tempting monthly number across the desk, you will know exactly what you are looking at. Not a deal, not savings, a beautifully packaged financial obligation dressed up to feel like a bargain. Share this video with someone you know who is about to walk into a dealership. You might just save them thousands of dollars and years of regret. And if you want more content about making smarter decisions with your money, hit subscribe because there is a lot more coming.